Coverage with no medical exam. Some policies as low as $1 a day. Answer a few health questions and get your free quote at ethos.com/term. That's ethos.com/term.
You're tuned in to Money Matters Boston, 1120 AM WBNW. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM. Concord, Boston, the Money Matters Radio Network.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Inflation and Your Retirement Plan. Mike, why is it so important for retirees to account for inflation in their planning?
Yeah, massively important, and I think any retiree over any course of history will tell you that. And when you experience inflation, when you're on a fixed income, it's tremendously difficult. But even small changes in the rate of inflation, or seemingly small ones, can really lead to massive changes. For example, if you're facing 2% inflation, that means that prices roughly double every 35 years. If you're looking at 4% inflation instead, those same prices double only in 17 years. A huge change to your budget.
And obviously, this also then influences, your overall spending habits and your withdrawal rate over time. These are things that you have to account for in your planning. You can't just assume that you're going to necessarily see the same kind of inflation that you've seen previously in retirement.
Yeah, look, I think generally speaking, over the course of the last 20 years, while there have been massive drawdowns in equities, the inflation figure has remained relatively stable. If you're worried about something that could look different from that over the course of the next 20 years, then it's important to really consider what that would mean for you.
Our guide this month is titled Inflation and Your Retirement Plan, and there are two ways you can request it. The first is by calling 800-393-4001, or you can request it online at armstrongadvisory.com. That phone number again is 800-393-4001, or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. Mike, Paul, and Tucker with you on a Tuesday where the Fed meeting is kicking off. Tomorrow we'll be hearing from Fed officials, Jerome Powell, on the path of interest rates. This morning we received some retail sales data and continued, I guess, just confusion and mixed news about the direction of this economy, labor market, and inflation. That's the only way that I can describe it. We described it that way yesterday as well. And this morning's retail sales report, I think, continued to muddy those waters a bit here, Paul. I want to start right there with that retail sales report as we have markets in slight sell-off mode. The NASDAQ barely negative for the day, the Dow off a little bit further. 8:30 a.m. this morning, we got a report on weather and how much consumers are spending across this economy, and the weather is the whether they're spending question is answered. They are spending. They're spending quite a bit. Who and where is an interesting question, but spending overall, retail sales advanced 0.6% overall. That beats the expectations of a 0.2% increase that most economists polled were expecting. If you exclude motor vehicle parts and gas stations, which we tend to do because they can swing things, especially big. Remember, these are not adjusted for gas prices and things like that. It's just a regular old print. That was up 0.7% off of expectations of 0.4. So by all accounts, beating all expectations, and that's in spite of a lot of complaining and concern that I keep hearing about the labor market and inflation. So I don't know, Paul, help me make sense of this report, because I guess my only making sense of it is we Americans are really good at one thing, which is spending irresponsibly, and maybe we're getting more of it here.
I actually had the reaction at my desk this morning. I literally said out loud, whoa, when I saw these numbers, because It was so counterintuitive to all of the general rhetoric that we've talked about over the last few weeks, where the backdrop of the economy focus has been weak labor market, job revisions, slowing growth, and then you have on a backdrop of inflation that has remained persistent and stubborn. You would think with those two things, persistent and stubborn inflation, that would slow down the consumer, right? You would think with a weaker labor market, that would also lead to the consumer slowing down. And this report, beating expectations pretty handily, was quite a surprise. But it does point to what's been really the story, Mike, of the last 3-4 years post-pandemic, has been a extremely resilient consumer.
Yeah.
And I've many times questioned how long that trend could keep going for. And
apparently quite some time.
And this report just backs that notion that the consumer continues to get out there and spend, and it is surprising to me. It's nice, it's welcome news, but it does make it harder to generate a narrative. If someone asked you, gee, Mike or Paul, how's the economy doing? After this report, I would say, well, a little bit of this and a little bit of that. It's mixed.
Yeah, and we will check in on, by the way, what all this means for the Fed's rate decision tomorrow, because this is another data point for them to consider, I suppose, as they're making their rate-cutting decision today. But taking a look at some of the details in the weeds here, again, we saw a 0.6% increase overall compared to, this is measuring data from the month of August, by the way, so we're a month away from it now, or 16 days away from it now. Compared to year over year, spending up 5% at these retail and food services business. Excuse me, did I say 0.5%?
5%.
I said 5%.
Yep.
Okay. Sorry. 0.6% month over month, 5% year over year is where we landed here with this report. Motor vehicle and parts dealers up 0.5% month over month. Furniture and home furnishings. This is an area that we saw a decline. That's down 0.3% month over month, but still up year over year pretty substantially. Electronics and appliance stores up 0.3%. Building materials and garden equipment, that barely moved. And that's, in fact, down year over year. And so I look at that one area and say, okay, I think I can make sense of that given housing activity. If you're seeing building material and gardening equipment and suppliers, Home Depot, Lowe's, the likes of them, falling a little bit, I think it's because of a lack of home building and a lack of home improvement projects that are going on. Food and beverage stores, you're up 0.3%, 3% year over year. Health and personal care barely moved, but still up 5% year over year. Gas stations moved up month over month, but gas prices overall are down year over year, so that figure is down. And then clothing and clothing accessories up a full percentage point in just a month, giving us an 8% increase year over year. Sporting goods, hobby, musical instruments up 0.8%, 4.7% year over year. General merchandise stores, I don't know what that means, down a little bit, but up year over year. Miscellaneous, I guess that's your 7-Elevens. That's down month over month, but up big year over year. And then non-store retailers, think online, up 2% in terms of sales. Finally, food service and drinking places, 0.7% bump, 6.5% year over year. I can't paint a picture of this that explains much of anything to me based on this data. I mean, here's one takeaway that I have. Consumers were a bit nervous about the state of things and seemingly pulled back their spending early on during the tariff announcements. We saw this. April and May retail sales data declined both of those months. April a little bit, May quite a bit. So, as big as this report was to the upside, the May report on retail sales was bigger to the downside. By June, people had kind of settled in. Mm-hmm. Said, you know what? Haven't lost my job. I know everybody's been warning me that I might. I know everybody's been warning me that prices are going to go through the roof, but haven't lost my job, still have my income, and prices aren't through the roof. I'm going to go back to normal. We saw retail sales increase almost a full percentage point in June. And then the last 2 months, July and August, we've now seen increases of 0.6% in each of those 2 months. So I buy the normalization piece on the consumer's part. It's not reflecting in hiring. You didn't see businesses go out and do the same thing, right? You didn't see businesses say, okay, we're really nervous about these tariffs, so we're putting off all of our plans. But then by June, we picked them back up. No, because we have not seen the pace of hiring like I was kind of expecting it to follow some of the consumer trends to say, oh yeah, businesses rather are no longer concerned about these tariffs in the same way. They're picking up hiring. Has not happened. So where does the Fed go, I guess, with a report like this where, hey, they're really worried about the labor market, but this could be inflationary?
It could.
Don't buy it?
No, I don't think so. I don't think retail sales gets weighted as heavily in that consideration pie for the Federal Reserve, where you probably have to attribute some of this retail sales to inflationary pressures. It's not adjusted for inflation. It's adjusted for seasonality and things like that. So some of this increase is likely from, some of the cost increase that we've seen. It still is a really strong report from a consumer spending side of things. But ultimately, I don't think this really drives the Fed to move in one direction or another. I think that their trajectory is set in stone. There's too much ammo on the labor market front that points to a weaker trend there to really deviate from their approach. It's a data point that I'm sure that they look at and review, but ultimately not enough to move the needle in terms of their trajectory of very likely cutting rates by 0.25% tomorrow.
Let's take a quick break here on the Financial Exchange. When we come back, I want to talk about that Fed meeting. A bunch of court cases that have been happening just over the last couple of days surrounding the Fed governors, but really diving into what is going to happen tomorrow during that press conference. That's next here on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Are you wondering where the economy is headed? GDP is growing, but tariffs, inflation, and job numbers are making headlines. Interest rates, housing costs, and policy changes are impacting all of us. Even AI is changing how markets move. Hi, this is Chuck Zada from the Armstrong Advisory Group. We're hosting 2 financial seminars this fall to help you make sense of it all. Join us at Margaritaville Resort Cape Cod on October 9th or at the Showcase Superlux in Chestnut Hill on October 16th. To reserve your seat, call 800-393-4001. We'll break down the economic trends, market risks, and smart strategies you need to plan for retirement and beyond. Diversification, preparation, and smart decisions are several of the keys to navigating uncertainty. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Register now for this year's DAV 5K on Saturday, November 8th at Castle Island before it sells out. Slots are going quickly, so if you'd like to take part, please visit dav5k.boston to secure your spot. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Sign up or donate today at dav5k.boston. That's dav5k.boston.
So talking about the 11th hour for a moment here, we have two, I guess not changes to members of the voting central bank at the Federal Reserve, but at least two that we weren't really sure would be able to attend this meeting given where everything was going, and they apparently will be. So let's start off with Lisa Cook. For reference here, if you have not caught this story, one of the voting members of the central bank, Lisa Cook, has been accused by, I'm trying to remember where the initial accusation came from. I think it was within the Justice Department, but it might have been
It was a Federal Housing Finance Agency Director, Bill Polt, who publicized the allegations.
So the allegations are that Lisa Cook declared two properties to be her primary residence. One would do this to get more favorable terms on a mortgage. That is the accusation, and the president has moved to remove her from that role. Two courts now have rejected that attempt. They have said that they have to give Lisa Cook due process to fight those claims, and the onus is on the White House to prove that she did this and that it is cause for firing. I think it probably lands in the Supreme Court ultimately, but we will see. In either case, a judge has now said, no, you cannot remove her, and so therefore she will presumably be attending this meeting coming up here today, and again, voting on the decision of where rates go tomorrow. The second piece, the Senate has now voted to confirm President Trump's pick, Stephen Miran, to the Fed board. He is replacing another Fed governor who resigned very recently. This is a unique situation. I believe it's the first time since the 1930s that a sitting member of the White House, a member in the White House, is going to sit on the governor's board. He is going to be taking a unpaid leave while working at the central bank, and this is a short-term arrangement because this exact seat is up for a new pick, I think, in February of next year. So again, it's a pretty unique situation, but nonetheless, he is going to be also voting at this Federal Reserve meeting. So, okay, none of this should actually change anyone's view on where interest rates go, and it doesn't really change my view on where interest rates go, but it's going to be a weird Fed meeting. Let's just start right there. You've got a newly appointed Fed governor that is coming from the White House, sitting at the Council of Economic Advisors, and
who's been very critical.
Has been critical of the other members of that Fed and has been pretty prominent in his views that rates need to come down. I would think he continues with that viewpoint in this meeting, but not necessarily. Like if I'm thinking about how do I want to actually be influential, and I just come out saying, hey, we should cut rates by 1%, then everybody's going to laugh me out of the room and not take me seriously for all the future Fed meetings. So I'm not sure that's what he does. Lisa Cook, again, people are going to pay attention to what she says, but you have to look at that situation and say 50-50 she's fired in the next 6 months.
Right.
So I would think that is not a terribly influential role either. And then finally, we have the governor himself, Jay Powell, who is going to be in that role, I think, right until his term ends. But his term ends in less than a year.
Mm-hmm.
you have seen this with previous Fed governors as well. This is not unique to Jay Powell, but the closer you get to the end of the term, the less influence you have, the more difficult it is to wrangle your members because all of them are vying for the role of the next Fed, the head of the Federal Reserve. And so his influence is going to be at least under question when it comes to this meeting. So I don't know that we see any of that in the meeting, but I am uniquely interested this time around to see how the governors are actually voting. I think you're going to have more dissents than usual.
Yes.
You could, I don't think you will, but you could possibly have dissents in both directions. So again, let's say the Fed cuts rates by 0.25% and they vote on that and the majority vote for that move. You could hypothetically have some members that are voting for 50 basis points, whereas others are voting for no cuts at this meeting, which would be, again, pretty wild and something that is almost never seen. But to set the record straight, they are almost definitely cutting by 0.25% at this meeting. The only pieces that are under question and really hoping to learn something about would be where the rest of the Fed thinks that rates need to go over the course of the next 12 months, given the current economic conditions.
Yeah, I think you hit all the major points there. The new appointees, what the decision in lies tomorrow is likely the 0.25 basis point cut. So other than that, I don't really anticipate it will be that exciting of a meeting. I understand the new members and things like that, but it will be parsing through the tea leaves for maybe some information on dissents versus,
because remember, it's not like
but
we get a video of the actual meeting, right? Like they might be screaming at each other behind closed doors. We would never know. So I think that part will be interesting, but none of us will really know. And I agree with you, Paul. When it comes to the press conference, it's going to be the same. Yeah. It's going to be because it has to be. If you have a panicking Federal Reserve, then everybody loses. So rates come down. Let's talk about what this practically means for everybody listening right now. Yep. I mean, markets, who knows what's driving markets on any single day, but the last several days have been pretty positive for markets. So let's start right there. What do lower rates mean for equity investors, I guess, first and foremost?
Yeah, so typically the lowering of rates would boost asset values, all else equal. Borrowing costs would go down for businesses to finance their operation from a growth perspective, and that would lead to higher valuations. So I think that's part of the movement that we've seen over the last week or two is the optimism regarding lowering rates and thus driving up asset values. From a consumer standpoint, just for the listeners out there, what does that mean to you? Hey, the CDs that I'm getting at the bank, maybe they were at 4.25% or 4.5%. Those will likely come down very quickly to 3.75 or 4%.
Yep.
On money markets, the same thing applies there. Potentially on the good side of things, for those people who are borrowing home equity lines of credit, likely those rates will come down because those are variable. And anything else, credit cards a little slower to move, but those same types of things, that's really what the consumer would feel from an impact standpoint.
Mortgage rates you have seen come down. It's not really because, I guess it's sort of attached to what the Fed has been promising to do here, but not really going to move the needle when they actually cut rates tomorrow, assuming that they do. You mentioned CDs. I just wanted to bring up a little story that I had with a client the other day, which is so common, but he was furious. Banks with a bank that I won't name. He had been in a really good interest rate CD for some time. He was traveling, it auto-renewed, and they renewed him right into a 1% CD. Now, not the end of the world. Yeah. He can pull the money out, but he does have to pay like $300 to get his money out of this stupid CD. And I just want to warn everybody out there that this is incredibly common. It happens with money markets at banks. It happens with CDs at banks. It happens with insurance companies and annuities. They get you with a teaser rate, and then the whole way they make money is they renew you in some garbage product when it renews. So buyer beware and keep your eye out on this stuff. Quick break. Wall Street Watch is next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know it's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest risks to retirement isn't just market volatility, it's longevity. People are living 25 to 30 years after they stop working, and that gives inflation plenty of time to work against you. At just 3% inflation, your expenses double in about 23 years. Add to that the fact that healthcare costs typically rise faster than general inflation, and your later years could be your most expensive. Without a plan, that combination can put real pressure on your savings. That's why we've put together a brand new guide called Inflation in Your Retirement Plan. The guide shows you ways to balance longevity risk with rising costs and strategies that may help you make your money last through decades of retirement. Call 800-393-4001 to get your free copy today. 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva with the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to deal with qualified retirement plan assets, and can they be transferred to these irrevocable Medicaid trusts?
So this is a tough asset in general. When you're dealing with retirement plan assets, it's difficult from an estate planning standpoint or a Medicaid planning standpoint to deal with them. Why? Because they have both an income tax component and an estate tax component, right? They're taxable when you take them out, and when you die, they're subject to your estate tax. So the general way to do this would be, one, you can name the spouse as the beneficiary of the IRA, or you can name the kids the beneficiary of the IRA, or sometimes you can name the trust the beneficiary or the estate the beneficiary. But it all depends on the size of your estate, the size of the IRA. But the one thing you really can't do is you can't take the asset and transfer it to the irrevocable trust or revocable trust while you're living. Otherwise, it will create a income taxable event. So tough to plan for those in advance unless you name the estate the beneficiary.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide called Why Name Your Estate an IRA Beneficiary right now by calling 866-848-5699. That's 848-5699, or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are pulling back slightly as the Fed begins its two-day monetary policy meeting today. Wall Street's also reacting to better than expected retail sales data from August, where retail sales increased 0.6%, higher than estimates of 0.2%. Right now, the Dow is off by about 0.5% or 204 points. S&P 500 is down about 0.1%. NASDAQ is completely flat at the moment. Russell 2000 is retreating about 0.5%. 10-year Treasury yield is currently flat at 4.034%, and crude oil up 1.3% today, trading just above $64 a barrel. Oracle shares climbing over 2% higher after CBS News reported that the cloud infrastructure company is among several companies that would enable TikTok to continue operations in the U.S. if a framework deal between the U.S. and China is finalized. Meanwhile, after surpassing $3 trillion in market cap for the first time yesterday, shares in Google parent company Alphabet are dipping slightly today. Elsewhere, shares in arcade and restaurant chain Dave & Buster's sinking 16% after it logged another quarter of declining same-store sales. Novo Nordisk said its experimental once-weekly weight loss injection drug helped patients reduce their weight by 11.8% after 68 weeks. Novo shares are up over 2%. Chipotle shares climbing over 1% higher after the burrito chain authorized an additional $500 million for share repurchases. In more news this morning from Tesla, after U.S. auto safety regulators opened an investigation into whether some of the company's electrically powered vehicle doors are defective. This comes after Tesla stock jumped over 3% yesterday after CEO Elon Musk purchased about $1 billion worth of Tesla's stock. Shares are up another 1.5% today. I'm Tucker Silva, and that is Wall Street Watch.
Paul, we just covered that the Fed is very likely to cut rates at this next meeting. They're likely to do so by 0.25%. This follows a trend that they had started back in the late summer, early fall of last year, and is happening at a time that I think is a little bit unique for the Federal Reserve to be cutting rates, I guess. And that's where I want to get to for a moment here. I guess before we even talk about data, I just want to ask anybody listening, and you're welcome to text us at 617-362-1385. Regardless of what I'm about to tell you in terms of data, do prices seem stable to you? Do you feel like you know? I think the easiest example I can give is, do you know when you go grocery shopping next week for your family what the price of that basket is likely to look like? And that's a really important framework for all of this. I know we talk about the data, we talk about the actual measurements, how much did prices actually move on a month-to-month basis, but so much of this is built on expectations that I really think how human beings actually feel about prices is probably as important as all these survey results we get. Do you feel prices are stable right now is what I want to know. My general inkling is not really. Like when I talk to people, part of it's because of tariffs, part of it's just because of the massive swings that you've seen over the last couple of years, that people don't feel terribly stable in their expectations for prices. Nonetheless, the Fed is looking at this economy and saying, yeah, they might be nervous about that, but we're much more nervous about the labor market right now and the weakness that we've seen in hiring. And so we think the prudent thing to do is to cut interest rates. And I'll be the first to say, like, I think you can justify that decision.
Sure.
I guess my question is, what if they're wrong like they were in 2022? Again, completely different scenario here, but we are facing a similar type of decision-making framework, which is we're more worried about the state of the labor market than we are about prices. We think any price increases that we're seeing right now will be temporary and then wash away. In 2022, depending on who you ask, they were kind of right, but pretty wrong on that. The part that they were right about is, the price increases that we saw did eventually fade, and we got back to normal inflation within a couple of years. What they clearly got wrong was just how big the price increases would be. And so I think there are some that are looking at this and saying, okay, justifiable to move now, but please be careful because we cannot live through another period of high inflation like we did just a few years ago.
Yeah, there's been a huge shift to focus primarily on the labor market, like you just said, and there's been less emphasis, it seems like, on the inflationary front. And the tricky spot that they could find themselves in is that you cut rates here and perhaps you likely cut again one more time before the end of the year. And typically when the Fed is cutting rates, they are trying to aid a slowing economy. As we've just discussed in the program, it's kind of mixed bag as to whether you'd say this is a slowing economy. The labor market is slowing. So by lowering rates, you are trying to enhance or trying to create more economic activity, more borrowing, more demand for consuming and all these types of things. But when you're dealing with inflationary pressure, like we saw in 2022, and where we sit today is a reflection of the fact that you have to increase rates to slow down consumption. And so Fandetti always uses the thermometer or speed limit, anything you want to say there, that would use as a good analogy. The problem is if we find ourselves in a spot where inflation is going up and the economy is slowing down, think about it as if you're driving a car that is in neutral and you're trying to put your foot on the gas. You're not going to go anywhere. There's really nothing that the Fed could do if that were the case. So I think it bears mentioning that that is a scenario out there when you shift away from inflation, and if it continues to tick up, that becomes problematic because then the Fed basically doesn't have the tool to solve what that problem would be if we got to that point.
Yeah. I just don't think we will.
I don't want to jump that far. A lot would need to go wrong to be there. Usually what happens for listeners out there is if you get rising inflation, the economy, comes down to a point where you just don't have enough consumption and demand for the products to kind of create that spiral of increasing inflation.
Yeah. I think there is this tail risk out there. I don't think there's a big tail risk of stagflation. I tend to think we will get one or the other. I think the real risk to inflation would be that, hey, with all going on, with the deportations and retiring baby boomers, that we're just dealing with this lull in employment right now that is about to swing to the other direction rather rapidly in sometime within the next year. And if that were to happen, right, retail sales and everything else has been keeping up even with this weaker employment scenario. Were that to happen, I don't think you'd get a recession, but I do think you'd get some higher inflation, and at the very least, the Fed would need to pause their rate cutting cycle, if not swing in the other direction, which, again, not the end of the world, but a bit problematic for doing any sort of planning, right? I thought rates were going to be coming down over the next year. Now they're moving up. My mortgage rates are getting more expensive again. All these things are changing. So that's what I see as the real tail risk here, is they're just getting a misread on the state of the labor market based on nerves about tariffs plus AI in some way that could just be temporary, just like the price increases I think are. But again, I don't know that I would be making a different decision were I sitting in Jay Powell's shoes.
Yep.
Or a chair. You don't sit in shoes.
I know what you mean.
Right?
You stand in shoes.
Stand in shoes, sit in chairs. In either case, we're going to take a quick break. And when we come back, we're going to talk a little bit more about that consumer. I want to talk about this retail spending report. I want to talk about where it's coming from, specifically the demographics of who is spending, who's not. That's next here on the Financial Exchange.
Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
Inflation, housing costs, and rising interest rates are putting pressure on families everywhere. From higher insurance and taxes to volatile markets, today's economic landscape is changing fast. This is Chuck Zada from the Armstrong Advisory Group. We're hosting 2 financial seminars this fall, first at Margaritaville Resort Cape Cod on October 9th, and next at the Showcase Superlux in Chestnut Hill on October 16th. Call 800-393-4001 to reserve your spot. We'll discuss how to manage risk, protect your retirement, and create a plan that can handle economic ups and downs. Whether it's core inflation, market volatility, or policy changes, you'll learn about strategies that may help you plan smarter. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Paul, the folks over at Barron's have an article this morning. The economy was weak in August. Retail sales may buck the trend. So I guess let's start off. Was the economy weak in August?
No, it was red hot. Red hot. We saw retail sales that were much higher than anticipated, coming in at 0.6% month over month, well above expectations.
I wouldn't say it was universally hot. I mean, there's got to be something we can point to that was weakness in August. The stock market was up like crazy, but hiring was bad.
Oh, I thought we were just talking retail sales.
No, just generally. Like, let's talk about the economy.
Oh, yeah.
They said the economy was weak in August, so I'm trying to find evidence to support or deny their argument that the economy was weak in August.
Labor market ticking up to 4.3% unemployment, 263,000 recent JOLTS claims, weekly jobless claims.
Yeah.
But those can be kind of volatile week to week, and you have the revision, again, backward looking, but 911,000 jobs stripped in terms of job growth from March of 25 through March of 24. Is that directly August? No, but that's
S&P
probably
gained nearly 2% in the month of August. And to your point, yeah, it was weak hiring, but it wasn't as though we had net job loss, I guess, is where I would go. So, I don't know. I'm with you. I don't know that you can universally describe the economy as weak in the month of August. There were some concerns justifying the Fed to cut rates. This spending report, though, definitely contradicted that other stuff. And it, I guess, is just a good reminder, which would be the consumer never leads a recession. People just keep on spending until their car gets hauled away by the repossessor, until their credit card gets closed up. People keep on spending if they have a job and an income coming in, and right now they, by and large, do. A small percentage point higher in terms of unemployment, but the other piece that I think is very worth mentioning is this divergence in terms of who is spending the money.
This has fascinated me all year.
It has to me too, and I don't know why it wasn't really on our radar in past years, because I'm sure that it has been a growing trend. But in the second quarter of 2025, consumers in the top 10% of the income distribution, and I'll have to look up what that means in terms of dollars, but folks who are in the top 10% of the income distribution accounted for 49.2% of the total spending in the second quarter. That's up from 48.5% in the first, and it's the highest level since this data point has been looked at going back to 1989. So the real story here to me seems to be one of a diverging wealth and income inequality, where those who own assets tend to also have higher incomes and are much more comfortable spending in this economy than the other 90% of consumers.
This statistic has rattled around in my head all year, where when we get all this conflicting information, and the retail sales is a great example of it this morning, Mike, where we have some weaker labor market data that we've been digesting, and then here comes out a retail sales number that is very strong. And perhaps this points to this idea that the top 10% are powering this retail sales report, or they're accounting for half the spending. So they're half the reason behind why we saw a pretty good number for the month of August. And I continue to come back to this idea, and I haven't got a ton of data on this, but does the stock market now have more significant impact on the health and the state of consumers than it did in years prior, because of this divergence that we're seeing here, where the top percent of earners, if you look at the distribution on who owns stocks as a country, the significant amount of ownership, a good 2/3 plus, is in those people who are in those top income percentiles. And so what we've seen over the course of this year is April, the market took a very steep dive, and you pointed to earlier, retail sales in April and May were very tepid on this idea that the uncertainty around tariffs. They've now resumed, and it's come in line with the stock market rally over the course of the last few months that has been very strong. And not to say that there's a direct one-to-one correlation, but it does seem like more and more, Mike, if we're going to have the top 10% driving so much of spending, a lot of their wealth is tied to the stock market. If they're seeing their net worth go up, I do think that provides some confidence for them to get out there and continue to spend.
By the way, I just took a look. The income figure you need to reach to be in the top 10% is around $150,000 as of the most recent data. So if you have household income of $150K plus, you would be considered within that top 10%, that top decile of income earners.
Hey, this fall, why just watch the leaves change when you could watch the sunset over turquoise waters? Well, the U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, Experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean paradise, the U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Paul, do you want to talk about earnings reports or Boston real estate?
Let's talk Boston real estate.
Let's go there. I have an unpopular opinion, although I'm guessing it's growing. Massachusetts economy screwed.
Okay.
Not forever.
Do tell.
Not forever, but I think that we are in a cyclical trend that is going to be pretty bad for the Massachusetts economy. And I think that could spell more real estate listings. It's already been a story of much higher unemployment, and that's my viewpoint. 3 days from now, we will get state-level unemployment data, so we'll see the latest data for the month of August for Massachusetts. But let me describe to you what's happened in terms of employment in Massachusetts since December of last year. I cherry-picked December because in December, that was the last time that the Massachusetts unemployment rate matched the national unemployment rate at 4.1%. Since then, the national unemployment rate rose from 4.1% in December to 4.2% in July, and then now 4.3% in August. In Massachusetts, December we were at 4.1. By July, we were at 4.8%. If that had happened on the national stage, the Fed would have already cut rates by at least 50 basis points, and we would be saying we are probably in a recession right now as a nation.
Sure.
I can point to a number of different things here. All of it would be guesswork. I assume that unemployment in the education sector and the biotech sector is all increasing. I've talked to folks in that area. And now you're starting to see it in terms of real estate with apartment owners in the Boston-Cambridge area just saying, yeah, we've got more vacancies than we have any time in recent history.
Yeah, I mean, the biggest issue that they're combating here is so much of the Boston rental market is unique and different than New York, for example, which is much more a month-to-month structure. So much of Boston revolves around September 1st, and for a good reason, because of a lot of students. And what you've seen is the amount of students on visas from China and India has declined substantially. There's been virtually no visa appointments for the last few months for those students in India. So that is leading to impact in the rental market.
I'm telling you, I think it's going to be a bit of a tough spell for Massachusetts residents, landlords, etc. Quick break. A lot more to cover in the second hour of the Financial Exchange. Stay tuned. We'll be right back.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. and they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte-Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This month's free guide from Cushing & Dolan is called IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection. Learn how naming your estate a beneficiary can reduce estate taxes, protect assets from nursing home costs, and avoid the 5-year Medicaid waiting period. Call 866-848-5699 to get your free guide today, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month on the topic of inflation and your retirement plan. Mike, a lot of people listening might be familiar with the idea of the Consumer Price Index, the CPI, but rare is it that we find someone whose own personal rate of inflation exactly matches the CPI consistently.
Of course, we all have different spending habits. We all live in different parts of the country and have different effects of inflation. But I think a great example here, Chuck, is during a large portion of the 2010s decade, CPI was relatively in control, and people got very little in the way of increases on their Social Security. However, healthcare inflation was pretty hot, and Medicare prices went up pretty dramatically during that period of time. And that is one area that dramatically affects retirees that doesn't play into CPI all that much and resulted in people seeing their Social Securities just not growing a whole lot during that 2010 decade. And so you really do have to evaluate the risk of, hey, here are my spending categories, and how might things like changes to the labor market or changes to energy markets, if I live here in the Northeast and I can't get natural gas and I'm instead relying on oil prices, how could those changes really affect my future finances?
Folks, our guide this month is titled Inflation in Your Retirement Plan, and the way to request it is by calling 800-393-4001. You can also request it online at armstrongadvisory.com. The guide again is Inflation in Your Retirement Plan, and that phone number to call is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on a Tuesday before a Federal Reserve meeting. Wednesday, they will be they'll announce their rate decision at 2 p.m., followed by their press conference at 2:30 p.m. tomorrow. In the meantime, we received retail sales data this morning that we'll dive into, and markets are in slight sell-off mode with the NASDAQ down 0.1%, S&P closer to 1/5, and the Dow off about 0.4% in early trading here. Paul, anything else catching your eye in terms of markets or data that I missed this morning? I think that just about covers it for us. We're not seeing any massive swings out there that are worth mentioning. Nothing of the oracle-kin that we saw last week, for example.
No, nothing that stands out. You've hit on all the major ones there.
So the job market, let's go to the retail sales first. The retail sales numbers that we saw for August have reconfirmed something that we've been seeing for the last few months, which is a consumer that's continuing to chug along and pay their bills and expand their spending. Now, again, retail sales data does not get adjusted for inflation, and we are seeing a fair bit of it. In the month of August, you saw headline inflation that came in at 0.4% month over month. We saw retail sales that came in at, how much was it, Paul?
0.6, yep.
So what does that practically mean? It means that consumers bought about 0.2% of more stuff.
Right.
They just paid 4/10 more for that stuff that they bought. And so we do see this scenario now taking shape and really forming pretty solidly around higher income consumers handling all the expansion when it comes to spending in this economy, whereas those, I guess I would say, other 90% just kind of cobbling it together to be able to, put stuff on the table and maintain their existing spending. I don't think they're falling apart, but a number of indicators would point to that direction, whether it's auto loan delinquencies, trade-ins of underwater vehicles, mortgage delinquencies aren't at a concerning level, but all of these things have indicated a more stressed consumer, and yet the one that keeps on spending.
Right.
So this doesn't likely change the odds of a Fed rate cut tomorrow. In terms of those odds, we'll just check in on them now from the Chicago Mercantile Exchange.
96% probability, or 96% probability that we see that quarter basis point cut. Still 4%. So you're saying there's a chance. 50
basis point cut. Yeah. I mean, this is normal at this stage. It's pretty tied in that, we're going to get that cut. Again, compared to a month ago before we got this jobs report, there's only an 85% chance of a cut at that point in time. But this weak jobs report that we saw last Friday, 2 Fridays ago, September's all blending together.
2 Fridays ago.
Really, I think solidified the Fed's perspective on this economy right now, which is we're in a bit of a concerning level of job creation, concerning enough that it'll likely impact the overall unemployment rate. And so we're going to pay more attention to that than we are the inflation data. A piece from Bloomberg today seemingly, sorry, is this the Wall Street Journal? Barron's, neither of the two. Piece from Barron. Tucker would tell me, but he's chewing an apple right now. Can you turn your mic on? We all want to hear that. Arguing that, look, the weakness that we're seeing in the labor market, and to point that out, several months now of fewer than 100,000 jobs created. June, we actually saw net job loss. The argument that she makes here is, look, we have to get used to a new normal in terms of the labor market. And that new normal is a significant portion of baby boomers retiring every month.
Right.
And a significantly smaller share of work being done by illegal immigrants or undocumented immigrants or their related family. And so, therefore, you cannot use the same rules of thumb when measuring this labor market as you once could.
It was an interesting way to lay it out, where we have been concerned that we've seen a significant reduction in job creation over March of 25 through March of 24. The Bureau of Labor Statistics had come out recently with that revision, trimming off 911,000 positions. But the argument made here in this piece in Barron's is that as we go forward, if there's going to be a lesser supply of workers, then you don't need to create as many jobs as you were previously. And what she uses as a comparison piece is back in 2023, when the labor market was in a very great place and had just come off the 2 years of 21 and 22 where we saw a ton of job hopping and an increased amount of demand in the labor market. The break-even rate, which is basically the amount of jobs that you need to create on a monthly basis in order to satisfy the amount of people employed in the labor markets, was above 125,000. She's now arguing that this year that break-even number is somewhere around 60,000 because we have way less in terms of immigration inflows into the United States, only around 500,000 this year compared to 3.5 to 4 million in 2023. And like you mentioned before, Mike, the baby boomer generation is retiring more significantly in droves as well.
Yeah. So, I mean, put very simply, whether it's, Kathy Bostjancic, who's Bostjancic. I've heard her interviewed several times. I want to get her name right. She's the chief economist at Nationwide, or the Federal Reserve Bank of St. Louis has estimated another number. But in either case, the number of jobs you need to create every month to keep the unemployment at these current levels of 4.3% is probably somewhere between 30 and 80,000, approximately half what you needed back in 2023. And that's all defined by a shrinking labor pool to do those same jobs. And so, again, I think people are generally aware of this, but to me, if we're looking at, hey, what could possibly cause higher inflation, and if we're worried about it over a prolonged period of time, to me, it's this more than any of the tariff stuff.
How so?
So the tariff-related stuff, I do think will have an inflationary impact, and I think we're starting to see it, right?
Mm-hmm.
If you look at the most recent CPI report, which came in at, where were we, year-over-year numbers of like high 2s, low 3s, month-over-month number at 0.4, so a pretty uptick level. What we're really seeing there is, services inflation has been rising, but that's always kind of been the case. You always start to see, because wages go up, you see services inflation. But goods inflation is now kind of matching all of that. My perception of goods inflation, you're going to see an uptick, and then when you compare it to a year from now, unless we're in a really prolonged trade war with escalating tariffs, then it's going to be a one-time adjustment. You're not going to have to worry about it for the long term.
Okay.
The labor market story is not a quick fix. Like, anyone out here, if you were an economist and you identified that, hey, our demand, and I don't think we're there right now, but if demand for labor starts to outstrip supply, there is no quick fix to that solution. AI might be one of them, but otherwise you have to increase immigration. That's the only quick fix to a super tight labor market. And tell me one politician in the country, Democrat or Republican, that genuinely thinks they can get reelected on that framework. I don't see it. And so, yes, tariffs are going to have an effect on prices. If you want to talk about what could actually drive longer-term inflation for a decade, to me, it's the labor market.
I just don't know how we get that tight necessarily on the labor market perspective. We were at 3.5% unemployment, and maybe you could make the argument, well, Paul, that was almost too strong. It led to all this inflation. Yeah. Maybe I'd argue, I'm making all these arguments myself, was that supply chain shocks, that's what led to that, and the infusion of trillions of dollars into the economy, Mike, that was the reason why it was problematic, not the 3.5% unemployment. It would be a long way to fall to get back to those levels, which we would all agree were extremely a tight labor market, to the point where the employees had so much leverage that it led to this inflationary
and
piece.
they very clearly do not have that leverage today. My only point about this is not a trend that is just going, the labor supply story is not one that is going to change on a dime. It is going to be a long-term shift in the supply of labor in this country. And I think the potential effects could be inflationary. And we just won't really know how that all works out. If we go into recession and AI starts replacing a bunch of jobs, then nothing to worry about. If instead we're in this new environment 6 months from now where taxes are lower and interest rates are lower and housing picks up, and suddenly companies are trying to hire people in a labor market where there's just not enough people to hire, that is a scenario that drives wages higher and drives prices higher and lasts a long time.
Mike, I've done my part. I've had 3 kids. I can't add any more to the potential future labor force.
Can't or won't, Paul? Won't. Can't or won't. Let's take a quick break. When we come back, a little bit of trivia here is next on the Financial Exchange.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Every dollar you've saved in retirement accounts and life insurance tells a story of hard work, smart choices, and the future you envision for your family. One way to help that story end well is to make a beneficiary choice that does more. This month's free guide from Cushing & Dolan, IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection, explains how naming your estate as the beneficiary of your IRA or life insurance can add a layer of tax efficiency and nursing home protection, while still allowing your spouse access when it matters. It's about keeping more of what you've built working for your loved ones now and in the years to come. Get your free copy today by calling 866-848-5699. That's 866-848-5699. Or you can request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Inflation, housing costs, and rising interest rates are putting pressure on families everywhere. From higher insurance and taxes to volatile markets, today's economic landscape is changing fast. This is Chuck Zada from the Armstrong Advisory Group. We're hosting 2 financial seminars this fall, first at Margaritaville Resort Cape Cod on October 9th, and next at the Showcase Superlux in Chestnut Hill on October 16th. Call 800-393-4001 to reserve your spot. We'll discuss how to manage risk, protect your retirement, and create a plan that can handle economic ups and downs. Whether it's core inflation, market volatility, or policy changes, you'll learn about strategies that may help you plan smarter. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
All right, time for trivia here in the Financial Exchange. And in case you missed it, sad news in Hollywood today after acting legend Robert Redford passed away at the age of 89. Redford had a legendary career in front of the camera, but not many remember that he had a great career behind the camera as a director. Redford never won an Academy Award as an actor, but he did win as a director. So our trivia question today, which movie did Robert Redford win Best Director for at the Academy Awards? Once again, which movie did Robert Redford win Best Director for at the Academy Awards? Be the 5th person today to text us at 617-362-1385 with the correct answer and win a Financial Exchange Show t-shirt. Once again, the 5th correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Paul, I think it was yesterday the president brought back up the idea of quarterly earnings reports on behalf of publicly traded companies. It is a requirement today. The president had made an issue of this back in 2018. Barack Obama had done the same in 2015. Which side of the argument do you want to take on this one? You in favor, or you want to keep getting the quarterlies?
You know, initially in prepping, I would have said that I was that I was in favor, but I'll go against, and I'll say keep
we need the quarterly reports.
And the reason for the stance there,
because you need a job, and what else would we cover on the financial exchange?
We would definitely lose. We would definitely lose on the financial exchange quite a bit. We would have very busy. I guess what would they do it June and December, or however they do it? We'd have some. Maybe the summer months would get really, really dry.
Yeah.
But ultimately, I come back to the more information that we can have, the more transparency, the better. The counter arguments that have been made to go against my position is, well, Paul, there's all of this juxtaposition that these companies do to try and beat these earnings analysts out there, these estimates. They're just trying to be above or beyond the expectations, and that causes them to think more short-term than long-term.
Here's what really happens is every quarter, companies come out and revise their earnings expectations, right? They don't just tell you how they did, they tell you how they think they're going to do. And so they play this really stupid game where they say, great quarter, but we're only expecting our business to grow by 3% over the course of the next quarter. And then they grow by 5%. And everybody applauds them, but they had already been planning to grow by 5% in the first case, and so they just wanted to beat those revised expectations.
And that generates this statistic that you'll often find quoted where S&P 500 companies, 80% of them are beating earnings expectations on a given quarter. And I would see that at the beginning, the first time I would say that, wow, 80% of companies are beating earnings expectations, but they're basically
They always have, and they always will.
It's like my 4-year-old, I'm just trying to get the bar for him to be able to jump over at 6 inches off the ground, and I'm constantly moving it so that he beats and jumps over that bar, and that's the same thing that companies do.
So my counterpoint to that would be they're just going to do that every 6 months instead of every 3 months. That's not going to change the incentive structure. The incentive structure is still going to be to beat expectations on your earnings, and right now you do it every quarter. In the future, if you did this, you would do it every 6 months. I think I can point to two main issues that I would say would lend some credence to this argument. One would be cost.
Yeah.
Two would just be a general longer-term focus that I would like CEOs to have. So on the cost side of things, we don't have enough accountants. You need accountants to report your quarterly earnings. It's costly to find those accountants and do this. There have been a number of companies, including Tupperware brands, Advanced Auto Parts, Lyft, and others, who have specifically cited a lack of accounting staff as the reason that they could not on time report their quarterly earnings and do their filings with the SEC. So I think it's costly. Private companies don't need to do this. Sorry. And we have been seeing a number of companies choose to stay private for longer this day and age. Part of that's because of a bigger private equity funding market where you can get access to capital in private markets. Part of it's probably the cost and burden of reporting earnings every quarter. A small part,
I don't think
but
so.
Part of it.
I just don't think it's a big enough expense that is the reason. I think it's all a biggest portion of it is the private equity and liquidity that has been outside of there. There's no way that Stripe sits there or OpenAI sits there. Geez, if only we didn't have to pay accountants with our $500 billion valuation to report every quarter. That's the reason why we're holding off.
Agreed. No, there's no company out there that's going to say, oh, now that I only have to do it twice a year, I'm going to go public. But everything you can tweak around the edges, I think, could make a slight improvement, and that marginal company might consider it. The bigger piece to me, and I don't know that going to every twice a year instead of 4 times a year changes any of this, but we focus too much on what CEOs are saying every 90 days. I'm much more interested in what a CEO can do for their business 5 years in the future rather than 30 days in the future, because the answer for 30 days in the future is next to nothing.
Right.
You can do nothing, next to nothing, to change your business in the next 30 days unless you've already been investing in it for the last 2 years. And so anything that you can do that slightly makes that focus a little bit more about what is my business going to look like 5 years from now rather than what's going to look like 90 days from now, I think is helpful. But quite honestly, I don't know that going to twice a year actually changes that. So my arguments for go to twice a year are mainly why not, rather than, oh, it's going to be revolutionary. I just don't think we get all that much other than media sensationalism and more ads for CNBC and Bloomberg by doing quarterly earnings reports. That's the main factor that I think is
Nothing
to the
wrong
benefit.
with that.
Is, hey, media gets to cover the quarterly earnings reports. It's something to talk about. It's exciting. analysts all over, are busier during earnings season. And so that's who I think the main benefactors of all this are, not the investors themselves, not the companies who are reporting quarterly. I think primarily, if I look at the beneficiaries, it's stock analysts who get to write reports every quarter. It's TV analysts who get to cover this, radio analysts like ourselves who get to cover it every 90 days. And quite honestly, I just don't think that's a good enough excuse for why you should have to do it every quarter. I just don't think we lose anything.
Yeah, ultimately, no loss, no gain, really, with this.
If your business changes mid-quarter, there's nothing that would prevent you from coming out to the general public and saying, hey, we had a revolutionary new thing, and we're going to tell you about it at our quarterly earnings report, but just so you know, we're revising our expectations up or down on our business. And so you don't lose much, I don't think, by going to twice a year. Feel free to tell me why I'm wrong. But first, we're going to take a break and go to Wall Street Watch next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest risks to retirement isn't just market volatility, it's longevity. People are living 25 to 30 years after they stop working, and that gives inflation plenty of time to work against you. At just 3% inflation, your expenses double in about 23 years. Add to that the fact that healthcare costs typically rise faster than general inflation, and your later years could be your most expensive. Without a plan, that combination can put real pressure on your savings. That's why we've put together a brand new guide called Inflation in Your Retirement Plan. The guide shows you ways to balance longevity risk with rising costs and strategies that may help you make your money last through decades of retirement. Call 800-393-4001 to get your free copy today. 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Marc became familiar with after his military service ended back in 1984. As Marc built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Marc works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Marc Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to set up designated beneficiaries for qualified plan assets from both a Medicaid and estate tax planning perspective for a married couple?
Generally, for a married couple, you have several choices. The most commonly used one is you're you're going to make the surviving spouse the designated beneficiary. It doesn't shelter assets from estate taxes. It just passes to the surviving spouse. It avoids probate, and it's probably the best way to go from an income tax perspective, not necessarily an estate tax perspective. Another way would be you could technically name the trust the beneficiary of the IRA when you pass. That at least will help it shelter assets for estate tax purposes and still provide for the surviving spouse. But from a Medicaid perspective, it will then protect it from the nursing home, but it'll take 5 years. Perhaps the newest and best way to do this would be to name the estate the beneficiary, provided you are over age 73 or over. That way, it goes through probate into the will. It is sheltered for estate taxes. It is immediately protected from the cost of long-term care for the surviving spouse, and the surviving spouse has access to it as well.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide, Why Name Your Estate an IRA Beneficiary, right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets pulling back slightly as the Fed begins its two-day monetary policy meeting today. Wall Street's also reacting to a better-than-expected retail sales report for the month of August, where retail sales increased 0.6%, higher than estimates of 0.2%. Right now, the Dow is down by 0.4%, S&P 500 down nearly 0.2%, NASDAQ is dipping into negative territory, down about 0.1%. Russell 2000 is down nearly 0.7%. 10-year Treasury yield up 1 basis point, now at 4.045%, and crude oil up 1.5% higher, trading right around $64 a barrel. Oracle up over 1% after CBS News reported that the cloud infrastructure company is among several firms that would enable TikTok to continue operations in the U.S. if a framework deal between the U.S. and China is finalized. Meanwhile, after surpassing $3 trillion in market cap for the first time yesterday, shares in Google parent company Alphabet dipping into negative territory today. Elsewhere, shares in arcade and restaurant chain Dave & Buster's sinking almost 17% now after it logged another quarter of declining same-store sales. Novo Nordisk said its experimental once-weekly weight loss injection drug helped patients reduce their weight by 11.8% after 68 weeks. That stock is up nearly 3%. Chipotle up over 1% after the burrito chain authorized an additional $500 million for stock buybacks. And more news this morning from Tesla after U.S. auto safety regulators opened an investigation into whether some of the company's electrically powered vehicle doors are defective. This comes after the stock jumped over 3% yesterday following news that CEO Elon Musk purchased about $1 billion worth of Tesla's stock. Tesla up about 2% today. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question: which movie did Robert Redford win Best Director for at the Academy Awards? That would be Ordinary People. Ellen from Charlestown, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Ellen. And we play trivia every day here in the Financial Exchange. See complete contest rules at financialexchangeshow.com.
New York Times has a piece, No Longer Young and Now Laid Off, 5 Ways to Protect Your Finances. I've been thinking about this subject a lot for some reason. I think probably because of the Massachusetts unemployment scenario that we were discussing earlier. But I think the New York Times does a good job of at least accurately identifying a serious problem for folks in their personal finances, which is when you lose your job over the age of 50, it is critically important to have a plan. One, ageism is going to play out big there, and you are going to have a tougher time finding that job in almost every career path that you can find compared to somebody in their 30s. And it sucks. It's unfair, but that is the reality that I think anybody who has been in that position has faced is, yeah, when you're 55 years old, you have a whole bunch of skill sets, but they're oftentimes unique to your previous company. And if they're no longer willing to employ you, then everybody else is going to look at you with suspicion. Will they be good at our latest software that we just rolled out? Will they, be able to pick up things, and how much are they going to be looking for in wages? So that is the scenario that I think people face when they are looking at a layoff in that age demographic. What does the Times lay out in terms of strategies here to help protect yourself?
One good point that they make is typically with a severance package that you may get from a former employer, it may be a lump sum payment that you receive, typically a certain number of weeks of pay, depending on how many years you've been at the company. And so what they
paid out all at once.
They advise in that lump sum scenario, some it's paid gradually over time, but if you do receive that lump sum, not blowing it all as if it's some windfall that you need to go out and have a 2-month vacation or something like that. I mean, if you have the financial means to do it, by all means go for it. But I think it's that combination of managing that appropriately. If truly you're finding yourself tight and with limited emergency saving funds, obviously you want to make sure you use that severance very prudently, just like you were working, and also avoid taking money from your 401k. If you are under the age of 59 and a half, if you take money from your 401k, not only are you going to pay income taxes, but you're also going to pay a 10% early withdrawal penalty. So looking for other sources that you can draw from if the severance package isn't enough to cover you is important. Going to regular investment accounts, emergency savings funds, or worst case scenario, if you have a Roth IRA, there is some ability to pull back some of your contributions as long as it's been open for 5 years.
There is, by the way, a special exception there. If you separate from your job and have a 401k, there's a special rule that might allow you to take distributions at 55 instead of 59 and a half. So these rules do get pretty complicated. The 401k, honestly, like that could take a long time to think about all of the different effects there. Like there's fees that are oftentimes covered by your employer while you're working there that might not be covered once you're separated from service. You could have company stock in your 401k. What do you do about that? Health insurance, though, is like the very first one that comes to mind for me, Paul. Whenever I talk to somebody pre-65 who loses their job, that's the first one that I go to is, okay, what are we doing here? So, Cobra is the first thing that you get. You do get usually access to Cobra.
But it's startling how expensive that is for folks because oftentimes your employer has been covering 70, 80% of that cost. Right. Now you're covering 120% of it on your own. So it's significant.
So, at that stage, looking at other insurance options, maybe you were covering the insurance and your spouse wasn't, but hey, what does my spouse's coverage look like at that stage? Can I get something there? Can we get covered? Or ultimately, do we need to, turn to the health insurance marketplace, Obamacare? Do we need to go get something there in order to make ends meet here? I'm startled by how many times I see people just forego it in their 50s and say, I'll roll the dice on this. And man, you're one hospital ride there from being bankrupt at that stage, and be really careful before you go and make that type of decision.
Just want to revise 102% of the total premium for a Cobra, not 120.
Yeah. So long story short, losing your job at any point in time is complex and emotional and difficult in the best of times. Having it happen when you are over the age of 50 makes it that much more difficult. If you're trying to prepare for your eventual retirement and worried about what I've been discussing when it comes to the Boston area labor market, I'd like to invite you to one of two special events that we're putting on. This is an event sponsored by the Financial Exchange and Armstrong Advisory Group. We're hosting 2 live broadcasts of this show combined with 2 seminars from the Armstrong Advisory Group on 2 separate dates in October. The first one is going to be October 9th. It's at the Margaritaville Resort on Cape Cod. The second one is October 16th in Chestnut Hill at the Showcase Superlux. Again, live broadcast of this show. And then we're talking about this market, this economy, and the seemingly changing position we are facing when it comes to this. We'll be taking questions from the audience, live during the show as well as after during that seminar. So join us for lunch, join us for the broadcast, and just join us for an interesting and enjoyable time. We've done a few of these in the past. They're always great events, but they do sell out. If you would like to reserve your spot, please call now at 800-393-4001. The whole event is free to attend. Again, that number, 800-393-4001, or you can get a whole bunch more information right on our website. It's right on the front page there at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
The newest face of long-term unemployment is now the college-educated. We've talked about this trend line for a while now, especially newer grads. We are seeing that unemployment rate tick up. They are having a tougher time finding new work than previous grads, at least over the course of the last 10, 15 years. It is one of the weaker hiring markets for college grads that we've seen since the Great Recession. And I just kind of want to hypothetically play this out for a moment. So we seem to have a growing population of unemployed or underemployed. And by underemployed, I say, people that have jobs but want to be working more hours or want to be working in a different area of the economy. Yet the wealthiest 10% continue to expand spending. We saw that this morning in the retail sales report. Spending isn't dropping off. AI development is continuing at a breakneck pace because Google and Microsoft and others have boatloads of cash that they're working on spending on innovation and research and development. It spells a really confusing economy, I guess, is where I'm landing. Like, I don't know what the stock market does in that scenario. I don't know what the real estate market does in those scenarios, right? Like, all of that would logically mean higher unemployment rate. But if all of the assets, all the stocks are owned by that top 10% or a significant portion of them are, I don't know that it actually spells a terrible stock market scenario. It might just spell a really uncomfortable economy. It's really, really tough to navigate all of this and try and come up with, okay, what does this all mean for me, a 25-year-old, you, an investor at 45, and you, the CEO of a publicly traded company 2 years from now. Could you see a scenario where we hit 5% unemployment and yet the stock market's reaching all-time highs? I would say maybe.
I wouldn't have said that before, but with all the data on spending and just the concentration of spending power in the higher income deciles, I'd be more open to the possibility than I would have been 2 or 3 years ago, where it's just
5% is probably extreme because at that level, like, you do have eventually spending pulling back.
Right.
But it's just a strange position to be in right now, where growth is slowing in every area but AI. However, that AI spend is so big that it could float this thing forward for a few more quarters, years, or more. Quick break. When we come back, Stack Roulette is next.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Every dollar you've saved in retirement accounts and life insurance tells a story of hard work, smart choices, and the future you envision for your family. One way to help that story end well is to make a beneficiary choice that does more. This month's free guide from Cushing & Dolan, IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection, explains how naming your estate as the beneficiary of your IRA or life insurance can add a layer of tax efficiency and nursing home protection, while still allowing your spouse access when it matters. It's about keeping more of what you've built working for your loved ones now and in the years to come. Get your free copy today by calling 866-848-5699. That's 866-848-5699. Or you can request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England,
this is Chuck and
no
Mike from the
passport
Army.
required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit GoRedForWomen.org today to learn more.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visitusvi.com.
Time for a bit of Stack Roulette. What do you have for us, Paul?
I'm going off script a little bit, Mike, here. This is Luckin Coffee is now taking on Starbucks. Luckin Coffee, you guys might remember, listeners out there, it's the largest coffee chain out of China, and they became infamous during the pandemic where they had all sorts of accounting issues, Mike?
Yeah, it involves the company defrauding investors by fabricating over $300 million in sales.
That's what it was.
Then inflating expenses to appear more profitable and grow faster. So, yeah. Oops, not supposed to do that, it turns out.
Now, as of mid-September, Luckin has opened 5 coffee locations in New York City. They operate their stores without cashiers, and customers must place orders on their mobile app. They're not that much price different than what Starbucks is, but basically they do flood their customers with coupons in the app from anywhere of 30 to 50% off. Perhaps what got them in trouble before on the sales numbers is all the coupons that they offer. But they're really trying to make inroads in the United States. All sorts of issues. They went public on the NASDAQ in 2019, and then they fell from grace after that, a crowning fraud scandal in 2022. They were delisted.
Yeah.
Yep. But they're back, baby.
Yeah, I wonder how the coffee tastes.
I was just wondering the same thing myself.
I'm trying to think this through. Like, I guess I would feel more comfortable downloading a Chinese-based app for buying coffee than I would with having TikTok on my phone.
But neither
much. Of them give me the warm and cozies.
No.
I'm sure I have to share my location. You're going to have my bank account information. Why do I need to give you my address and social security number to buy a cup of coffee? This seems a little weird, but nonetheless, I'm sure it'll be fine.
Hey, Starbucks is weak. They're ripe for the taking.
Yeah. Look out, Starbucks. This is what happens when you blow through leaders like it's wildfire and then can't get your act together. So we will see if they can do so and put up a wall against Luckin Coffee coming into their territory. I don't see any of them trying to replace Dunkin' in Boston.
I just was thinking that.
Yeah.
I was just thinking that. I don't think the Massachusetts contingency will switch over that easily.
They don't have a good read on us Bostonians and how much we love our Dunkin'.
No.
So good luck next time, I guess, is the answer on that front. To make America affordable, we need to start with cars. That's a piece by Henrietta Moore and Arthur Kay, and I don't think that they are saying that we should have a policy of making cars cheaper. I don't think that. I think they're just accurately identifying just how crazy expensive cars are and how bad we are as Americans at evaluating that financial decision. Rather than when I first read it, I was like, so are you saying we need to elect public officials that are going to make cars cheaper? Because that's not really how capitalism works generally. But here's what they do point out is that a new car on average costs nearly $49,000. We then go and finance those cars over 7 years at interest rates higher than 6%. And so we're left with an affordability issue in this country when it comes to transportation that is getting a bit ludicrous. And I would once again say here that we have no one to blame but ourselves. No one to blame but ourselves on this. I am fascinated by Americans' car buying fascination. Why we need basically a robot on wheels these days and how expensive that is to afford and then insure is just nuts to me. But it's not General Motors and Tesla that is forcing all of us to go buy these vehicles. You can buy a really cheap Kia for a lot less than $49,000, or frankly, you can buy a Honda that's really cheap for a lot less than $49,000. But guess what? We don't do that. So, yeah, it would be great if we could make cars cheaper. But again, when companies try and roll them out and sell them, nobody wants to buy them. Honda rolled out the Fit a number of years ago, an outrageously cheap car. Nobody bought it. They discontinued it in the United States. Toyota rolled out the Yaris back in the 2000s. It was this tiny, really cheap car that probably would have done very poorly in the snow. But again, they discontinued it in the U.S. because nobody buys these small, cheap cars. Instead, we want giant SUVs. And, that's fine. Like that's what we want to buy, and that's what the car makers make a ton of money on, and that all works. But this is a problem of our own doing.
It's of all the problems, the housing market is probably the first place to start. But I get what they're going for on the headline thing. The cars is the next place to go. The good argument with cars is that it's a depreciating asset too. That's the other thing to mention. You're borrowing money for something that's going to be worth less down the road. So I get that point for sure. It doesn't make a whole lot of sense.
Markets are slightly down for the day. We've got a Fed meeting tomorrow, so tune in. Have a great rest of your day, folks, and we will catch you on the Financial Exchange then.